Hi, Adam.
Hey, Christine. Good afternoon.
Hi, how are you? Hi, everyone. I see a couple of people's online. Hi. Today we have financial advisor Adam, and he's also a Las Vegas resident. So we live in the same city. And then, yeah. So we're just waiting for the polls to be finalized. So we don't know what's holding up there. Okay. So before we get started, why don't you introduce yourself, Adam? Like, who's Adam, and what do you do, and what do you specialize in?
Sure. I'm an independent financial advisor here in Las Vegas. I specialize in retirement planning, investments, income, taxation, long-term care, legacy. And I was born in New York, grew up in the Bay Area. I moved to Vegas about 20 years ago. Live here with my wife and daughter. And it's a lot of fun and just to try to help people live their best life and navigate a lot of uncertainty and a lot of confusion and try to help them have confidence and clarity.
So do you feel like among all your clients, like what type of clients are you typically attracting, and what type of clients do you typically help? Like are those like the retirees, like the young people? What is your majority of your clients?
The majority of my client base is older, or retired or approaching retirement.
Mhm.
Um, I've been doing this 10 years now. And so client base, when I first started, I was working with teachers, a little younger demographic.
Mhm.
Um, So what I found over the years is that to make the biggest impact, where I'm able to help people make the biggest improvements is
Mhm.
is transitioning from the accumulation years to the distribution years when they're going from working to retirement, and they have to really factor in a whole bunch of other things. Start figuring out how do I take how do I draw down my money? Where do I take it from? What do I need to be aware of to not run out? What other factors, right? I do also work with some younger clients. I call them substantial savers during the working years. We incorporate tax-free retirement planning. So I personally, I'm on that path myself. That I feel like you pay taxes once, that's your responsibility, and the second time it's optional. But you got to know the rules and how to put that together and all that.
Yeah. Okay. So I know you're talking about so you help mostly the people who are now from accumulation to distribution. So tell us more about that. Like, how do you help them out to make sure that they'll have enough to survive on, to live on for the rest of their lives?
Well, it starts by asking a handful, about a half dozen, about a dozen or so questions about
Mhm.
their concerns. Then
Mhm.
it typically shifts into understanding where they're at now. What what does their picture look like? Do they have a pension or not? What is their how big or not is their social security? What is their income need? From there, let's say it's $25,000 a year, right? So in addition to the other things they're going to get, then you look at how much have they accumulated. So if
Mhm.
they have 500,000, then okay, well, you need to withdraw 5%. And different advisors talk about the 4% rule and different things like that, right? So well, we could go with investments, and I kind of call that an I hope so plan, because there's a lot of uncertainty and unpredictability. You can do really well, the money can last a long time, and it can also run out quicker because you could have losses and still, while you're still needing to take it out. You can So a lot of times it's a matter of shifting some percentage of their savings from the investment world into the protection world, where you can have guarantees that you won't lose principal, or you can have guarantees on income. And I know that that's can be a controversial topic in the financial advisor world, as you have the investment world, the insurance world. I believe they're not both right, they're not both wrong. That for most clients, obviously, it's all dependent on the client's risk tolerance and their risk capacity, and what are their other other areas that they need to address in their planning besides just investing. I consider investing like playing offense.
Mhm.
And for people that are sports fans, the financial world can be confusing. So as much as we can try to simplify it, sometimes the best teams have great defenses, right? It's not just about dropping back and throwing the ball 50 yards all the time, even though that's exciting and that hits the replay. great defense and running game can be the difference. So.
Okay. So you mentioned about $25,000 a year. I mean, yeah, that's pretty low. So okay, I'm just curious because you've been in Vegas for 20 years. I don't know how much of your clients are from Vegas. So how much are most of your people need to live on per year in Vegas? I'm just curious.
Well, so what I was saying, 25,000 in addition to their other income sources. So in addition to Social Security, in addition to a pension. So
okay, that's fine. But then,
yeah.
like for your clients who live in Vegas,
Yeah.
how much, like typically?
5, 6,000, 4, 5, 6,000 a month. It depends. Obviously, there. How.
I know. I'm just asking generally, like for this, like let's say older couple. I assume they're couple. Okay, within singles or couple, like okay, couples. You're saying 5 to 6,000 a month normally.
No, singles probably 4, 5. Couples. 5, 6, 7, 8.
Okay. Okay, that's including mortgage.
Well,
part.
Yeah, I would say the majority of my clients don't have a mortgage. So when you don't have a mortgage, then it can be lower, right? Because most retirees they don't want obligations. They don't want payments every month, for the rest of their life. So they just want that.
Okay. So listening to you say 45,000 with no mortgage, it sounds like your clients might be living the life there. Okay, because like I've had you can live on much less than that as well, $2,000 to $3,000 with no mortgage. So anyway, so I think it sounds like your clients who like to live the life, maybe gambling or whatever other stuff. So
people move here from California so they can or New York or Illinois,
That's okay. No, I'm just saying that's good. Thank you for sharing. So why don't we talk about several insurance? So I know you said actually before we get there, so I'm actually curious about part of the retirement income planning, like what do you think of reverse mortgages? So let's say I don't know, they quickly run out of money. So do you recommend reverse mortgage? And then like let's start with what is reverse mortgage, and then do you recommend that and how does that work?
So reverse mortgage is a home loan tool for individuals 62 or older. I'm not an expert on it. Don't do them. I'm knowledgeable. It can be a useful tool for people that know, hey, I'm going to be in the home for a while, and I either need, scenarios. One, they want to get rid of that ongoing payment and not have to worry about, the mortgage payment. They have enough equity to do that. The other scenario sometimes people find themselves in later is, I call it house rich, cash poor, where, you own your house free and clear, but you don't have money to do all the things you want, or travel, whatever. So I think the reverse mortgage is a great tool in either one of those situations. It can be, but I don't recommend anything all the time to anyone. It's all customized. So it used to be more attractive, the reverse mortgage tool. A couple of years ago, the regulations changed, the cost structure up front. So I think it can still be a great tool in certain situations. I just think now it's sort of narrowed down even more. So maybe it was the right tool, 20, 30% of the time, and now it's probably even a little bit less.
Okay. So let's talk about insurance. So I know you use insurance as part of your retirement income planning too, right? So let's talk about different insurance stuff, and then what strategy you should implement with your clients, and how do you use this as part of their financial planning?
Sure. So when it comes to their savings, we use certain types of annuities in one of two different ways. For guaranteed lifetime income, if they look at, hey, I have my $500,000 savings, and here's my income gap, and I'd like to not have to worry about having to worry about running out of money. So if we get an additional $1,000, $1,500 of income, we can reposition the amount of dollars required for that to accomplish that goal, and then they can invest the rest and not have to worry, accept volatility because they've built a solid foundation. We also use other types of fixed index annuities as bond replacements for the conservative portion of the portfolio, so that we have principal protection. So principal protection and then upside. So those are both insurance instruments. It's kind of insuring your money. But typically when people think of insurance, they think of like health insurance and life insurance, like a payment, right? These are all insurance products. Um, any question on that before I transition to?
So okay, so annuities. What kind of annuities do you recommend? What are different kinds of annuities? So okay, so just I just want to disclaim, like, I'm not recommending anything annuities or whatever. So this is just for education purposes, and Adam is just sharing, what he does. So you still have to do your due diligence to see if annuity is good for you. You have to work with a financial advisor. So annuity might or might not work for you guys. Okay. So yeah, tell us more about the different types of annuities, and then like um I guess when it's beneficial for certain people.
Yeah, there's four main different types of annuities: variable, fixed, and fixed index,
Mm-hmm.
and then also referred to as SPIAs, or different DIAs, single premium immediate annuities, deferred income annuities. That category is all about, I'm going to put a certain amount of money in, and at some point I'm going to start taking money out, get money from the insurance company for the rest of my life. Okay.
Mm-hmm.
There, where I don't do a lot of variable annuities, I don't see a lot of value in those. There can be in a certain scenario, but the majority of clients where I see the most value is in certain types of fixed index annuities, because you get three benefits. Number one, you have principal protection, so you don't have to worry about losing what you've saved. Number two, you have relatively attractive higher growth potential than other safe options like CDs or a fixed annuity. A fixed annuity is just a step up from a CD, where you know exactly what you're going to earn. Call it 2.5%, no more, no less. So the fixed index, you don't know exactly what you're going to earn. The worst that can happen is zero, but in a good year, you might earn 7, 8, 9, 10, depending on the product, the index allocation. There's a lot of confusion around those products, and there's a ton of products in that category that I think are terrible. I would not recommend, I would not use, but I'm independent, so I can go and pick and choose which companies and which products I can choose. And oftentimes over the years, it changes. Companies have an attractive product, 2-3 years ago, and not right now. And so, does that hit all the spots, or?
Yeah, sure. Okay. So okay, so what about, so do you okay, so fix like annuity, when do you buy that? Do you buy that when you're retiring, or you buy that earlier on?
So it's going to depend. So I go through risk profile questionnaires. I have a couple different ones, and like a lot of advisors, clients are generally going to fall into one of 5 categories. So conservative, moderately conservative, moderate aggressive, or aggressive.
Okay.
The more that someone is moderate to moderate conservative then they're going to lean more toward the annuity. If someone is moderate aggressive or higher, then they might not want to use it at all, or just for a small portion, just as that for a portion of the 60/40, for a portion of that 40 as a bond alternative. But I tend to resonate more with conservative, moderately conservative individuals. And, I have clients that use CDs, and so they wish they could still use CDs and get 4%, right? So, as the world changes, we have to change with it if we want to get the best results. And interest rates have dropped. So, it's just, I would say in general, people tend to start looking at these types of products more when they're 55 or older, 60. A lot of times when people in their working years, most of their retirement savings are in their employer plan, and they don't even have access to options like this. They only have access to plan options. So a lot of times it's when people are no longer working, or if they're over 59 and a half, a lot of plans have access to an in-service rollover. They can take some of the money out that they want to have principally protected, working in a fixed index annuity, for example, leave the rest in the 401k plan and use the mutual funds and stock market-based investments. That's primarily, I would say. But again, I also have a lot of clients in their 70s that, they're like, well, hey, I have this CD. I was earning 2%, but now it's 0.5. What else is there? Like, well, we have some investment options. I also do a lot of structured notes on the investment side. That I find that I do a lot of educational workshops and presentations and stuff, and I find 95% of people aren't familiar with that. People are familiar with stocks and bonds. I think now more than ever, it's important to look at alternatives, whether annuities could be a portion of it, whether it's structured notes, REITs, volatility strategies, just things that are different than stocks, bonds, and right now, obviously, gold and Bitcoin is popular too.
Yeah. Okay. So tell us about the LTC. I assume that's called long-term care, right?
Yeah.
Okay. So when does someone need long-term care? I think like people are like wondering, oh yeah, do I need the long-term care? Like what? So talk about what is long-term care, and then when is it? What are the typical people that actually that needs LTC?
Well, so if you look at statistics from AARP and Medicare.gov, the statistics support that 2 out of 3 65-year-olds at some time in their life are going to need some form of care, whether it's home care, nursing home. And so I'm a numbers guy, and it's just like, that's one of the biggest risks of retirement, right? Because if someone needs to be in a nursing home, that could cost $8,000, $10,000, $12,000 a month. So we're talking about $100,000 a year. How's that going to get paid for? And we can retain that risk and hope it doesn't happen, or we could look at different solutions to have some protection in place. So if we find ourselves in that scenario, we're not having to go through our own money, and the government gives a lot of incentives. There's a lot of tax advantages to these types of products. So in a short answer, the best time to incorporate into your planning is the younger and healthier you are. I'm 46. I have an index universal life policy that I use for conservative accumulation, liquidity, flexibility, access now. It has a death benefit to protect my family. They need that. And it has a chronic and critical illness rider. So that can add benefit. I don't know what's going to happen. Am I going to live a long time and need money? Am I going to pass away soon and my family's going to need money? Or am I going to have an accident and illness, and then I can have a chronic or critical? So a lot of times we see a lot of value in what's called hybrid plans, where there's benefits in 2 or 3, 4 different areas, because we just don't know. The world's very uncertain. So again, we want to get as much value as we can for our money. When it comes to long-term care, there's a couple reasons why a lot of times I see that people have gaps and don't have the protection in place. Number one, the traditional way of addressing it is with a traditional long-term care policy, where you have a monthly or an annual payment, and if you never need the benefit, there's no other benefit to you or your family. So we kind of call that use it or lose it. Either you pay, if you don't need the care, the money's gone. And so that's not attractive for a lot of people. And so it's also not attractive to have a payment in retirement for something that you hope you never need, right? So a lot of times, some income annuities will pay double the lifetime income in a care situation. So it could be an annuity type product. It could be a hybrid long-term care, or life insurance with long-term care or chronic illness rider. There's a lot of options out there today that wasn't available 10, 15, 20 years ago.
Okay. So Anthony Rafalo, CFP, says, no to annuities are bad. I use them. It should be part of the discussion. Okay, so he has a question. I do have my opinion of annuity, but I'm not going to share it. Okay, so Anthony asked, why doesn't anyone ever talk about preferred stock from utility companies as a bond alternative? 5% divided rates, low risk, 100% liquid, preferential tax treatment, 15% flat qualified dividend rate versus ordinary income on annuity gains. Plus, with an annuity, you got no step up in basis of debt. So I'll let you answer that. What's your opinion on that?
I think that's a great potential strategy to incorporate for a portion, 10, 15, 20%, type of thing. I think one of the challenges in the industry is that a lot of advisors only know a few different areas, right? And the longer you're in the industry, the more education, depending on, how you're set up and who you work with, then you may start getting more knowledgeable and familiar with things like Anthony's talking about. I mean, that's a very specialized area, right? He's talking about utility stocks, preferred stock. So be an expert. If you're an expert, then you can advise how this tool fits or doesn't fit, and to what degree it fits, right? But the problem is that the majority of people aren't experts in preferred stock of utility companies. So it becomes harder to, I'd say a lot of people aren't even aware of it, right?
Mm-hmm.
But does that make sense?
Yeah. Hopefully, Anthony, thanks for bringing that up. So, okay. So I know you also do investment management. So tell me more about, like, what's your philosophy around investment management, and do you have a minimum to manage people's investment? And then how is your pricing? Do you do financial planning fees, and then on top of that, you charge for investment management fees?
So my approach to investments is, hope for the best, but protect against the worst. So it's just matching up clients and have their money working for them in ways that are appropriate for them. So if someone is moderate aggressive, then we can exchange traded fund, equity models. Like I like to do structured notes, incorporate some hybrid things so Anthony mentioned utilities. I use managed volatility. I understand that. We use what's called a wrap fee. What I like about that is whether there's 220 trades or 500 trades, clients, they pay one advisory fee. We use TD Ameritrade Institutional. I'm independent, so there's a lot of flexibility. So I don't set hard minimums. And what I look for in clients is a few things. Number one, I look to be comprehensive. So the majority of clients, I'm not just doing one thing for, right? And so ideally, we're doing planning. So we figure out, right, what percent of the money needs to go for protection, for income, for care. The rest we can invest. How should it be invested based on your risk tolerance, and so forth. So if we're starting with planning, I generally offer it on. I can't offer it on an hourly. I like to do it on a flat fee basis. I don't like to be a clock watcher and all that. So the first conversation is complimentary. Before I want to work with someone, I want to see if I can add value for them. I want to make confidence that I can help them improve, and need to spend some time getting to know someone and really understand what they're doing now and what they want to do, and are there things that I think I can bring to the table that they're not doing that would be better for them. So there's 3 different ways I can work with someone. One is planning. Second is investment management, and the third is insurance solutions. And the majority of clients, we do all 3. In some cases, we start with one or the other. For people that have other advisors and they're sort of looking for a second opinion type of thing, I think a planning approach is a good place to start, right? To review the portfolio, understand, ask them, get my understanding of what their risk tolerance and risk capacity. Those are 2 completely different things. And I think one of the challenges in our industry is a lot of the questionnaires, they'll ask things like, when do you plan on drawing from your money? How much do you rely on income today? And so if you say, they'll ask questions like 1 to 4 years, 3 to 5 years, 7 to 9, 10 plus. And so the further away, it'll put you in a higher risk. Right? So that's your risk capacity, right? You don't need the money, so you can afford to take large losses. But that doesn't mean that someone is comfortable with that, right? And so a lot of times, if people take more risk than they're comfortable with, and then December 2018 happens, March 2020 happens, a lot of times people freak out and they want to sell after large losses. And it's really difficult to have long-term success if someone is going to do that. So I like to spend time up front and really figure out, how are you going to react when this happens? And if you're going to counteract the investment process, maybe we need to look at other options, invest less, so that you can put the buy low, sell high. You can put rebalancing. putting more money into aggressive things after large declines. I also like to do, scale out a little bit. So markets go up, let's take some of the risk money out and put it in things that are more conservative. But it varies.
Yeah. Okay. So okay. So I know you also do tax planning and legacy planning as well. So it's like, I mean, I just currently partner with another tax professional who has a master's in taxation. So we do the more difficult tax planning together. So let's talk about like legacy planning. So how do you how do you plan that? Like it's like, I know like people use like, rentals or the 1031 exchanges, and they don't have to worry about like then they don't have to pay the taxes when it goes, that seems to be what rich people do to try to plan their legacy. So anyway, what's tell me more about that. Like how do you plan around their legacies? I'm sure about 20 years in Vegas, then you probably did a bit of legacy planning, right?
Yeah, so it's very customized for each individual, right? There's no right or wrong, what people's desires are. So a big part of legacy planning is making sure that they have the right documents in place on the estate planning side, which I'm not an attorney, I don't do that, but I connect my clients, make sure that we have that squared away. So healthcare directives, financial powers of attorney, wills, trust, and so forth. When it comes to legacy planning, so there's two things. Is what do you want to happen with your money? Do you want an outright distribution? Do you want assets? Do you want to control things, right? Do you want to protect them? Attorneys call them, creditors, predators, right? Divorce, lawsuits. The specifically what as far as, so there's that's the legal side. From the financial side, what we're looking is how can we take these assets, whatever it is, that you're planning to leave to your kids, your grandkids, whatever, and maximize it for their benefit, the amount, and to minimize the taxation on those funds, right? And so there's a couple of ways to do it. One is a stepped up in basis. So, real estate, stocks, after tax things like that. If there's built up gains upon death, can pass. The other thing, so a lot of clients utilize life insurance because the death benefit is income tax free. So you have to be aware of the size of the estate. There could be estate tax. If that's a factor, then we need to incorporate, there are ways around that, but utilizing trusts and so forth. But for most people, so for example, might have a 72-year-old client and have a CD, or they sold a piece of real estate. Now they have this money and like, I don't really need it. It's kind of rainy day money. What could I do with it? So, we would generally put it into a single premium index life policy where they have cash value, they have guarantees, they can use it for them, tax deferred on the cash if they need it. They have a chronic and critical illness rider so that if they need care, they're getting more than what they put in, and they're getting that money tax free from the insurance company. And if they don't take the money for themselves and they don't use the care, then there's the death benefit, tax free, larger than what they put in. It depends on the age and the health, So a lot of times people want that and they can't get it because they procrastinate. They wait too long, and they have a health change, right? That's common. Sometimes people will have required minimum distributions on investment IRAs, and they don't need it, but they have to take it. So we take the money out, pay the tax, put the after-tax money in. Instead of a single pay, now it's a 5 pay or a 10 pay, type thing.
Got it. Yeah. Okay. Thank you so much. That's really very helpful. So Adam, like, do you have any last words to share our audience into, like, just about their finances, what they need to do, like any last message you want to share with them?
I think get educated. There's a lot of information out there. Sometimes it can be information overload. You can find, on Google, whatever, to me, when you hear people talk about always do this or never do that, that's a huge red flag. To me, that's a run, because these are just tools, insurance policies, annuities, stocks. They're just tools. They all have pros and cons, hammer, screwdriver, wrench. Doesn't make it good or bad, but you got to know what tool do you need? What are you trying to accomplish? And then you got to know how to use the tool. And that's where there's a lot of differing opinions, and a lot of it there's no right or wrong. But I also think focusing on what you can control, and that is, like you mentioned, taxes. It's black and white. It's the rules. If you know the rules and you apply them properly, you can have a better outcome than someone that doesn't know the rules and isn't applying it properly.
Yep. Yeah. Yeah. Financial coaching, money coaching is really about the rules. So that's more like, is emotional, is not black and white. So when I deal with clients with money, like why they do what they do is very emotional. So it's not that a tax is very black and white. It's like you follow the tax code or you don't. Oh, well, actually, not necessarily. Sometimes if you know how to defend yourself, let's say you like did something and then like you're good at defending yourself, you might be able to get away with some things if you know how to appropriately interpret the tax code. So there has been cases like that. So anyway, so thank you so much, Adam. I really appreciate this. And then, so how can people find you? I just tag you on this LinkedIn Live, so if people want to connect with you, they can connect with you. So like, where do you normally hang out, and how can people reach out to you if they want to chat with you more?
I'm on LinkedIn. We have a company page. I think a great resource is my website, www.askadamgoodman.com.
Okay. All right. So you're just on LinkedIn. Are you on Facebook, Instagram?
I'm on Facebook. We also have a company page on Facebook, but I'm not as active. I have a Twitter, but not as active. No IG. So
yeah, LinkedIn is your home.
I like LinkedIn,
Yeah. I do like LinkedIn too. So I think once I settle more in Vegas, I'm gonna get back to being very active. I used to be very active. So hang on, everyone. So I will come back again, but at least I try to come on at least once a week to this LinkedIn Live to actually say hi to you guys. So anyway, thank you, Ada. I really appreciate this. And then it's Friday. Have a great Friday, and then and then have a great weekend. Thank you.
Thank you, Christine. Appreciate it. Thanks, everyone. Take care.